Welcome back to the channel, Future Financial Strategists. Today, we're diving deep into the fascinating world of hard-to-borrow stocks and the mechanics behind a potential short squeeze. We screen thousands of equities every single day to identify unique situations, and one company has recently popped up with some truly eye-watering metrics. We're talking about RYOJ Company Limited, trading under the ticker RYOJ. This is a prime example of a stock showing classic signs of being extremely hard to borrow, and we're going to break down exactly what that means for you. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Show RYOJ logo/chart. Let's zoom in on RYOJ Company Limited, or RYOJ. This company operates in the industrial sector, specifically within consulting services, providing labor and corporate consulting alongside health services primarily in Japan. It's a relatively small cap company with a market capitalization of $50 million. Looking at recent price action, RYOJ has been on the move. Today, it saw a gain of 1.38%. Over the last 5 trading days, the stock has climbed an impressive 13.40%, and looking back 30 days, we see a substantial increase of 40.58%. However, let's talk volume. Today's volume for RYOJ was only 45,400 shares, which is significantly lower than its 30-day average volume of 469,743 shares. This translates to a relative volume of just 0.1 x, indicating very low trading activity compared to its recent average. Highlight low volume. What is cost to borrow and why it matters? So, what exactly is cost to borrow or CTB, and why is it so critical in the world of short selling? When an investor wants to short a stock, they first have to borrow shares from a broker. The broker charges a fee for this loan, and that fee is the cost to borrow. It's usually expressed as an annualized percentage. The higher this fee, the more expensive it is to hold a short position. Why can it exceed 100%? Because it's an annualized rate calculated daily, and when demand to borrow shares far outstrips supply, brokers can charge exorbitant fees, often much higher than standard interest rates, reflecting the scarcity and risk. A high CTB indicates strong demand from short sellers coupled with a dwindling supply of available shares. Why this stock is hard to borrow right now. Show CTB number on screen. This is where RYOJ really stands out. Our screen reflects RYOJ Company Limited with an astronomical cost to borrow fee of 596.4% annualized. That means short sellers holding positions in RYOJ are paying nearly 600% of the stock's value each year simply to keep their short position open. While the CTB momentum has seen a decrease of 56 percentage points over the last 5 trading days, meaning the fee has come down slightly from an even higher level, it remains exceptionally elevated. Adding to this scarcity, there are currently only 300 shares of RYOJ available to borrow across our monitored brokers. Emphasize only 300 shares with an estimated float of 2.3 million shares. Having only 300 shares available is an incredibly tight supply. Our internal composite squeeze score, which combines factors like CTB level, momentum, borrow supply, float size, and technical setup, puts RYOJ at a moderate 43.4 out of 100. This combination of an extremely high cost to borrow and an almost non-existent supply of shares makes RYOJ a classic example of a hard-to-borrow stock. Squeeze mechanics explained. For those new to the concept, a short squeeze occurs when the price of a heavily shorted stock rapidly increases, forcing short sellers to cover their positions by buying back shares to limit their losses. This buying pressure further drives up the price, creating a cascade effect. Where a stock like RYOJ has a CTB of nearly 600%, that cost compounds daily, putting immense pressure on short sellers. Every day the stock doesn't drop, they're losing money just to maintain their position. With only 300 shares left to borrow, it becomes almost impossible for new short sellers to enter the trade, and existing short sellers find it harder and harder to exit without pushing the price up themselves through buybacks. The shrinking supply of shares effectively traps them, potentially leading to a squeeze if positive momentum builds. Dilution risk check. An important factor to consider in any short squeeze thesis is the risk of dilution. Dilution occurs when a company issues new shares, effectively increasing the total number of shares outstanding. This can flood the market with supply, depress the share price, and completely negate any potential short squeeze, even if the cost to borrow is very high. New shares can provide liquidity for shorts to cover without much price impact. For RYOJ, we've checked for recent diluted SEC filings such as SMINUS 1, SMINUS 3, or 424B prospectuses in the last 90 days and found no evidence of any. Additionally, there has been no recent reverse split found for RYOJ in our look-back window. This means that, currently, dilution isn't an immediate concern for RYOJ, which is a positive factor for a potential squeeze scenario. Remember, this is complex territory. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, what should you keep an eye on with RYOJ? While a nearly 600% cost to borrow and practically no shares available to borrow are strong indicators of a hard-to-borrow situation, it's crucial to understand that a high CTB does not guarantee a short squeeze. It can also signify that short sellers have incredibly strong conviction in their bearish thesis and are willing to pay a premium to maintain their positions, believing the stock will ultimately fall significantly. For RYOJ, despite the recent price increases, the exceptionally low trading volume is notable. What you'd want to see for a potential squeeze to ignite would be a sustained surge in volume, signaling increased buying interest. Watch for any further reduction in the already tiny number of shares available to borrow, and any renewed upward pressure on the CTB fee. Significant price momentum, driven by high volume, would be the catalyst to potentially force shorts to cover their costly positions. RYOJ Company Limited RYOJ presents a truly fascinating case study in the world of hard-to-borrow stocks with its sky-high cost to borrow and near-zero shares available. While the current lack of dilution risk is a positive, the low trading volume means any significant buying or selling pressure could have an outsized impact. Remember, understanding these mechanics is key to navigating the market, but always do your own rigorous research. If you found this deep dive into RYOJ insightful, please hit that like button, subscribe for more unique stock analysis, and let us know in the comments what other hard-to-borrow situations you're watching. We love hearing from you.